Greetings, Dr. Jeffrey Scott here, and this is my weekly market update. I'm actually doing this on the 11th, even though it says the 12th. I respond to comments both within YouTube and via email at hgsidoc@gmail.com. If you're new to my channel, please subscribe and then hit the alarm, and you'll get notified when I place them. I get one up every weekend, but I don't always get them up at the same time. Other thing is, apparently, if I want to get this shown by YouTube to people besides friends and family, it's good to have those up thumbs hit. So if you like what I do, please recommend it with that thumbs up. If you don't like it, thumbs down and tell me why, and I'll see if I can't improve. That's me in the lower left-hand corner. I am a physician. I was presenting at a healthcare conference in New York in the fall last year. Titled this week, will technical damage lead to a retest of the October lows? I think a better question would be whether they hold. And then inflation data on deck. And again, hgsidoc@gmail.com. As always, this is for educational purposes only. Any recommendations are in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm independent. No one pays me to say good or bad things about theirs or anybody else's tools. I've paid for the tools that I use, and trading involves risk, and you alone are solely responsible for any investment decisions you might make. This is one of the fun things I get to do, which is present at the Wealth 365 event. I'm one of the few folks that has nothing, who doesn't have their own education service or company, and I've been invited to do it by Rob Hoffman, who actually gives me a website I'll mention to you in a second to use as well. I will put the link in the YouTube channel. For those that are not getting that via YouTube, it's not hard to copy that down. I'd really appreciate if you sign up using my link. I don't get anything, fees or anything when you do that, but I do appreciate them let me present. And frankly, if I don't have a lot of people come on, that may hurt my ability to do this in the future. So if you can use my link, that would be great. I mentioned the website. It's called stocksanddocs.com. If you like these videos and you want something more frequently, I try and put something up during the week. I'll admit that when I travel, it's hard to do that, and I travel a lot, so I do the best I can, but that way I can talk to you midweek as well. I always like to start at the top. So for those who are new to my channel, I'm going to look at the markets from a top down. I'm going to give you my take on what the market's doing and a high level view of what I'm doing from a management of my portfolio and my money perspective. Then I take a look in usually wealth charts, because that's a growing platform that a lot of people use. When I use something else, I get negative comments. But I'll use some wealth charts, show you how I look at it from a top-down perspective, bottoms-up perspective, and I usually leave you with my thoughts about short and long positions. I'll just cut to the chase. There's not a whole lot I like long right now. I think we could bounce here, and I'm going to talk about that, but I really think this market's going lower, and you kind of have that feeling if you're around in 2008 when I was on a treadmill, when I used to actually use those things, and I was watching TV when I was running, and that was the day that I think it either could have been late 07, but I think it was 08, when the money markets, where you put $1 in and it dropped below $1 in value, and kind of started feeling like that, and I'll explain that as we go forward. In yellow are the major indices. Now, if you look at the only things that were up on the week are things that go up in a bad market: the dollar, gold, and bonds. Now, the dollar being up and gold being up, I think gold was up because of fear related to potential run on the banks. You could see that some things like the Russell were just massively destroyed, down 8% on the week. NYSE and Spiders down 4.5 on the Spiders, 5.3 on the NYSE. Technology down between 3.7 and 4.7. That is a remarkable week. Really quite remarkable week in the market. Now, the interesting thing is here, you could see how far up each of these indexes are from their October 13th lows. If we're going to retest those October 13th lows, and to me, why wouldn't we retest? And maybe that would be healthy for us to have a purge so we could start over, because what will happen is the Fed might actually have to change their stance. But if we were to retest, we still got double digits drop to go. So I think this market is heavy here. I think this market could go lower, but I'll tell you why you could see a bounce first. This is the Q Edge tool, and I love it because I'm a bucket guy. You'll see the buckets in a few minutes from EdgeRater, but this gives me a real-time buckets. What the buckets are doing is they're taking a Bollinger Band. We're considering if your stock is below the Bollinger Band, you're -1 or less than 1. If you're above the Bollinger Band, you're greater than 10. And then we take between the top and the bottom Bollinger Band, and we assign percentages to them, and we divide them up into 10 deciles. So what you see here is at the close on Friday, 94% of the stocks in the S&P 1500 are trading below the midline of their Bollinger Bands. That is bearish. Maybe too bearish, but we'll talk about it. And more importantly, yet almost 44% of the stocks in the S&P 1500 were trading below their Bollinger Bands. Since stocks will stay within the Bollinger Bands over 90% of the time, if the entire student body is to the left, you know they're going to rotate back to the right with some reversion to the mean. So at some point, and I'm going to put a disclaimer on this to wait till you see a coming up slide in a bit. At some point, we're going to have a massive reversion, and that will be the bounce. We'll see how long it takes. Now down here, it shows me sector, industry group, and stock performance looking at 1, 2, 5, 10, and a month. You know, the funny thing is 2 weeks ago, there was a lot of green over here. This was such a bad week in the market. All sectors, all industries were down, and 98% of the stocks. That is as bad as it gets. And you could see it's been enough to flip 2 weeks and the whole month to be very bearish. And you could also see up here, led by real estate, all the sectors were negative. Now these are S&P 1500 groupings, so they could be a little bit different numerically on the percentages than the S&P 500 sectors. Now, white is the rates, so the 10-year and the 30-year came in on the week as the markets turned down, and I think that economic fears and what happens if we get a run on the banks. Now, I have been in the camp that we have a recession coming, and this is the main reason here, that you see when the yield curve inversion ends is typically when you start to get the recession. Now we're still very inverted. Now what will it take for the yield curve to revert? If it means the 2-year is larger than the 30-year or the 10-year, you know, which is strange because typically you'd want to charge more interest on the longer durations. But if the 2-year is higher than the 10-year and you invert, the 2-year has to come down. Well, when will that 2-year come down? The 2-year will come down when the Fed starts cutting. Now, or the market starts to anticipate a cut. Now, a recession, an economic slowdown, is kind of the thing that usually starts to get the Fed to cut rates. Notice what happened between the 8th, when we broke above 5, and the 10th, where we dropped down 45 basis points from 505 to 4.6. So is this falling 2-year telling us about the recession coming? Sometimes the private sector will front run the Fed. Now the other thing, if you look at stocks above the 200 in white, stocks above the 40 in white, and the 12-week new high, new low in white, really deterioration in breadth. And this goes with my buckets, that when we start to hit this white line, the markets will bounce, and we're very close to that. Again, why you could see a very short-term bounce this week. You could. There's some reasons why you might not. Now, I mentioned the buckets. Here you are close to 45 stocks below, 94% below the midline. all you got to do is go back to February 1st and think about how great January was and how when February came, the market, people talked about how February is a weaker market. Market started to sell off. And you could see on February 1st, we closed with 85% of the stocks above the midline of the Bollinger Bands and over 22% of the stocks above. Well, we know what happened. They moved back in. We are going to resolve this, and that resolution or reversion to the mean is going to cause a rally. And if I look back, this went back a number of years, but you could see that when you had this type of a picture, that usually it was near a bottom or at a bottom and the markets rallied. Now, there's a problem with saying that. I built this before an educational program years ago, and I built it during the midst of a very long bull market. So the question is it going to behave differently? And it might. Because as bad as this looks, 45 and 94, let's look at what happened in 2008, revisiting that year again. 94% and 45 were seen on October 3rd. So the exact same pattern that we saw today. And I'm thinking that we might reverse soon. So this was on a Friday. On Monday, we went to 50%. On Tuesday, we went to 70% below the band. And then we started to improve here on the 8th, 50%. On the 9th, we went backwards again, 70% plus. And then that was probably the bottom of the market. Notice how there was nothing above the midline, the Bollinger Bands. So as much as I feel that we are very oversold here, and I pointed out in the buckets, in the Q edge, and I showed you on the stocks above or below moving averages and the new high, new lows. In a bad market, oversold markets can get even more oversold. Now, I also thought it was interesting, if you look at the NASDAQ, they actually, if I look at purely the data, now remember the Hindi is really an NYSE, but I run it on the NASDAQ too because, hey, it's a whole different makeup. Notice it actually threw a non, what's the word? If you want to qualify this, you want to have a second one fire within 30 days. So it's not qualified yet, but it had a Hindi. But notice the number of new lows are double digits on the NASDAQ. The number of new lows on the NYSE are creeping up. This market has seriously deteriorated. Now this is the Edge Rater tool. So I took fundamentals that I saved on March 2nd, and I asked going forward over the next week, how do they predict what the market would do? Notice that everything is below zero. It doesn't matter where you were on this chart, you lost, your stock was likely down. Now I always throw out the tail and the head because the numbers approach zero. But within this, there's really no pattern here that says growth did better. No value for earnings. Yes, no relative strength, underperformed, but still relative strength did not save you. Just an ugly week in the market. Now, I introduced you last week to Dr. Pound Dollar, and this is something he posted on YouTube, and he was nice enough to share with me. And I'm looking here at a weekly chart of his black swan indicator. And you know what? I probably don't want to do this that way, but what you can't see, because I put this here, and actually I think I can probably fix that. Let's in slideshow. Let me move it here and let me start the slideshow back up. Excellent. I just wanted to show you that his indicator, and now the interesting thing is it didn't fire perhaps with some of the short massive pullbacks. You didn't get the red, but the red is fired during the times when you had the recession and a bear. It fired in the 2000, 2002. It fired in the 2007, 2008. It's been firing massively, and I called it out last week. And I could show you daily, weekly, or monthly charts, and they're all red. And so, I used that last week as why I might not be excited to stay in this market. And I think that this thing has got my attention. Follow him on YouTube, Dr. Eurodollar, Dr.354 to look him up. So it's a euro dollar, not the pound dollar. Sorry about that. Or you can look up Black Swan Indicator version 3. Know your news and earnings. This is a doozy week, folks. We got CPI, we got PPI, we got jobless claims, we got production, economic index, consumer sentiment, tons of earnings. And oh, by the way, guess what we get on the 22nd or 21st? We get the Fed. So the good news is the Fed's going to have a whole lot of data to consider going into the upcoming meeting. Be careful, guys. So comment about the market, and then I'll talk a little bit about the banks. Losing week for the market, as I showed you. You had Powell testimony before Congress that was decidedly more hawkish. February employment report too strong. You've got the SIVB, which is a Silicon Valley Bank, being shut down. You had downside moves this week. Had the S&P, the NASDAQ, and others slice through support. And Friday in the week we're on bigger volume. Lots to be concerned there. That SVP financial turmoil, I don't think it's over, because after hours, one company after another started talking about how much risk they had. ROKU had 26% or 25% of its cash at SIVB, and they dropped 6.2%. A stock I used to own, Axosome, came out after hours and said, hey, we've got cash sitting at SIVB. Now, for us normal folks, we may not have more than $250,000 sitting in a bank. And that's how much I think the insurance covers. If you had $10 million in cash, what happens if the bank shuts down? The government's probably not going to, well, it doesn't have to. It may or may not backstop you. As I understand it, if you have holdings, stocks, bonds, unless there's fraud and they're commingling and using your stuff as collateral, which a reputable bank would not do, my personal understanding is your holdings are not at risk, but if you have massive cash, it could be. Technical damage occurred across the markets. I showed you the Hindi on the NASDAQ. I don't often talk about a Phoenix, but we had one, the NYSE, which is another breath signal of a broken market. Breakdown of support on volume. You know, there are reasons to think we're going to get a rally. This was a fast sell-off. This was baby out with the bathwater. Now, if that occurred after the market had massively sold off over the last 3 or 4 months and we were at, recent lows, and then we had this day, then that could have been the day that told us it was the end, it was time to start going long. I don't think that's what this was. We are still well off the October lows. So, news-filled week, I showed you each data point would be closely scrutinized, and these bank failures just add to the challenges that the Fed has. How do you slow inflation without killing an economy when many of us, myself included, think the economy is already slowing down and we have a recession imminent as the Fed is continuing to raise? Big problem. We're seeing layoffs. I think it's time to stay defensive. And to me, defensive means cash. I've been talking about it for months. I still have a lot of cash. Did I get hurt this week? Sure, I got hurt this week. I have too many positions, but my positions are teeny weeny. And, I'm not putting any big positions on or taking massive risk. And I'm still going to be thinking short term. Contra ETFs are the other way I play this, and I started nibbling on those on Thursday and Friday. Now, here's a scary slide. This is looking at unrealized loss to total equity of some of the banks. So SIVB became insolvent when their unrealized losses were greater than the value of all their holdings and or their total equity. And that's type of a thing started to run on the bank. Now apparently they were in a quiet period because they're getting a $2.5 billion loan from another financial institution, and they couldn't come out and say that. And apparently a lot of these big shots in Silicon Valley were tweeting that they're taking their money out because the bank's in trouble. And I think that's what causes a run. Look what's sitting next to SIVB. Now, most of my wealth, unfortunately, sits in the wealth management division of Bank of America. So I've already sent this slide to my money manager asking, what is my risk? And again, I don't think you have a whole lot of risk of money that's in holdings. If your cash exceeds 250, I mean, obviously check with your financial advisors on anything you do and anything I say. But Bank of America, imagine if BAC failed. I don't think Bank of America can fail. I don't think the Fed can let it fail. I bet it does not fail, but I bet the price comes down. I bought some in single digits in 2008. Maybe we'll get a chance to do that again. But if you're looking for a reason why the Fed's going to stutter, I think we found the reason that could get the Fed to pause. We'll see what happens. We'll see what the data is this week. But if we start hearing that the Fed is going to have to pause because of the bank weakness, maybe that turns out to be a reason for the market to bounce. All I could say is, wow. Again, if you like the stuff that I do, if you like how I present the market, please use my link and come visit at Wealth 365. They usually have 50, 60, 70 other speakers. You got Rob Hoffman, who's awesome, talking until 9 or 10 o'clock at night. You get to purchase his Wealth Charts platform at the best price typically of the year. And many of the people, myself included, have some tools that they offer at a special price as well. I use this slide all the time, and I'm just going to stay here, and then I'm going to go on to the charts. On the left, market bottoms are the blue line. Fed rates are the black line. Market bottoms do not occur until the Fed cuts rates. We're not at a bottom. On the right, this is the average bear market, that black square, unless you get the red one, which is in a recession. So if we have a recession coming, we haven't seen 40%, 50%, 60% drops in the indices. So we may only be halfway there. So that's why the recession, I talk about it. That's why I'm concerned. I'm only going to do one video tonight because I don't think I'm going to have an extensive back end of it. But let's end the slideshow and let's go look in wealth charts and take a look, just like I do myself, on a daily basis and sometimes, rarely intraday when I have time. If you look at the hot stocks, and what you're just looking for, not necessarily the things that are leading, because leaders would have numbers here of 700 or 800, but you're looking at things that had a big move up, technically. Gold, municipal bonds, silver, and gold miners. Again, none of them are leaders. Those are not what you want to see if you're a growth stock investor. That tells you got a troubled market. It's funny, on my wealth management side, I'm not young. I'm 65, although I still feel the same as I did when I was 35 or 40. And I never had much bond portfolio. But over the last few months, I've been building a bond portfolio. And I noticed that they didn't go down when my stocks did in the managed accounts on Friday and Thursday. Perhaps we're going to get into an era where having bonds is good. Now, why would I say that? Well, the last 2009 is 13 years ago, 2007, 15 years ago. We've been in a world of no interest rates. Bonds don't do well when there's no rates. When bonds go up, they fall. When do bonds do great? When rates fall. And I think whether it's a recession that puts us into falling rates or the Fed starts cutting to prevent a recession, I think bonds may be attractive here. Plus, they're holding up better than equities. Consult your financial advisors. That's just what worked for me. Let's look at some of the indices and see if I can't show you what I'm looking at, what my concerns are. So let's just go back to where this market rolled over. And I suspect we can probably find some Fed speak, but you could see on the 3rd, and this is here's the 6th. All right, we ended last week here. And if you look at last week, we closed heading up. And then on Monday, we actually gapped up, but then we pretty much hit the high of the week at 11:20, 11:30 on Monday. Sold off on Monday. On Tuesday, sold off. Wednesday, we started to flatten out and actually started rallying. And I think that's when Powell probably spoke the first time. Maybe he'd already spoken up here, I think. And then we dropped down, failed at the 200, and sold off Thursday and Friday. This is a rough week, and we closed near the lows on the week. And as I'm going to show you when I look at the daily, this was not on light volume. In fact, let's just look at the weekly volume. You could see well above average volume on the weekly. We're going to come back to the weekly charts. So here's the spider. Technically, it broke through my mother of all trend lines that everybody will draw going back to the December, January highs. So breaking that is not good, although it closed just below it. It broke through the 50 and the 200 on massive volume. The MACD has rolled over and OBV has come down. The new high, new low. I'm not looking at OBV there. Sorry about that. This is a weak market, and it's a falling knife, and I'll show you more falling knives as we go. If we look at the Qs on the daily charts, does it look any different? No, it broke down below the 50 and the 200. The difference is it's still above this longer-term trend line on big volume, but that's a breakdown on big volume, maybe holding up a little bit better than the spiders. The diamonds, which were the big leader, has broken through support. Not good. Not good. It's also broken through the 200 on pretty massive volume. If we look at the Russell, I feel like a broken record. Broke through the 50 and the 200 on massive volume. These are not good looking pictures, and they're not telling you good things about the short term of this market. Now the VIX, VIX had a great week. Look at the VIX. Big gap up here, and it kept on going. Look at this is the VXX, but on the week, my goodness, the VXX on the week was up 385%. The problem with holding these things for any length of time is you just got back to where they were in April 21. These are not investments, but imagine if you put all your money or part of your money into the VIX on Thursday when the market sold off. You would have had a pretty nice day on Thursday. But I think what it really is a measure of the volatility. Now, my good buddy, may rest in peace, George Lee, used to say, when the VIX is low, look out below, and when the VIX is high, it's time to buy. Again, that could go into the column that says maybe we should get prepared for that bounce. The banks worry me. That's why I'm hesitant to say good things. And the dollar came down a lot. It was down 0.63. This is the UUP. On the week, let's look at the dollar on the week. The dollar was up a tad on the week, a green candle up 0.14%. So the dollar still looks a lot stronger than any of the major indices. Now, I've been one that's been hoping the dollar would drop back below this white line, which was kind of my line in the sand, but fortunately it did fail at the 200. And if you are bullish, you'd like to see that dollar come down. If I look at commodities of the weaker dollar and with the fear in the market, you'd expect gold and silver to do well. Gold has run up to the 200, a break above that. Maybe it retests the old highs. Again, a weak dollar, concern about bank failures. are things that should propel gold. If they think the Fed's going to stop raising, that'll help. Silver hasn't done as much. Oil is sort of in a sideways trading range, probably closer to the bottom of it. And natural gas, which fooled us and actually had a big move back here on the 3rd and then opened on the 6th with a 12% drop. Natural gas continues in the penalty box. Fear in the market, no surprise that rates dropped and you're now back below that double top level, in fact sitting on the 50. Again, if you're long-term bullish, being long-term now is kind of painful. You want not just the dollar to come down, you'd like to see the 10-year come down as well. My market timing model, it's turned. You have to be, price had to close above the weekly WMA with the green bongo, breakdown on the spiders, breakdown on the Russell, breakdown on the diamonds. They're all in sell mode. The only thing that's holding up, and when I say holding up, it's an exaggeration because it's just above the weekly as the Qs. But, you know, I mentioned before, they're probably the stronger part of the market. They haven't broken yet, but maybe they have less banks. But I think on Monday, if we have a lot of ROKUs and Axosome, techs and biotechs and other recent startups that have risk and exposure to SIVB, I think that'll take the NASDAQ with it as well. A lot of damage here in the sectors. Looking at the sectors compared to the spiders, you could see the materials have given it up. Things like steel really came back. Financials looking horrible. Energy not looking good. Industrials have held up better than most, and technology still holding, but both off their highs. Staples, utilities, and healthcare have moved up, probably defensive pattern. Real estate's probably got other issues to be concerned about, and perhaps that's why real estate did not follow the other defensive stocks. So I know you're going to be surprised, but I'm not going to show you a lot of things to buy. I'm joking about being surprised. Heat map, you know, it's interesting. Tesla, including after hours, did okay. If you own Tesla, part of that was probably finding out that Cathie Wood's buying again. And perhaps we'll find out that Tesla doesn't have any cash in Silicon Valley Bank. Because I think that's going to be the news of the week. As I mentioned, ROKU came out after hours and said that they have a quarter of their cash there. And this is before, but it dropped further after hours. So that's going to be, I think, the story of the open on Monday is how many of these companies are going to come out, because they have to. Whether it's a 10K or a press release, they're going to have to disclose how much of the risk they have that's material. FRC is another one of these banks that got hammered. This is a San Francisco bank. And what you're going to start to see is this here, where how much is too much to fall. And you know, here's a stock that was as high as 145 going back a little bit over a month ago and actually got down into the 40s. And perhaps some of these, and even something like JP Morgan, have fallen so much that maybe that the risk here and the contagion is not as bad as it could be. So it'd be interesting to see if we don't get a snapback in some of these stocks. But I think you got to be careful. And I think bank runs and bank failures don't occur often in our lifetime. If we look at Wealth Scanner to see if what's driving positive is anything is a better question. Notice again, no numbers here are very big. Highest is 425, and that's the dollar. I got technology software holding up as well as others, but when you look at the chart, it came off its highs. U.S. transportation, actually, you know, sold off pretty hard on Friday. Aerospace, Boeing, sold off hard on Friday. What didn't sell off hard are the next three things. One of them being bonds. I mentioned bonds, like when the rates come down and the Fed doesn't stop it, will have to stop tightening. They also go up like gold in periods of excessive pessimism. So you had a strong day on the TLT, was up 3.45%. The contra ETFs, things that go up when the index it follows goes down, SQQQ on the day. Let's just look at the week on SQQ. Again, not an investment advice, just a trading tool when you think this is the right thing to do, is up 11.84% on a rough week in the market. SARK goes up when Cathie Wood stuff goes down. Well, small cap growth did not have a good week, so SARK was up to the tune of 11.64%. So there are things you can try to the upside, but if we just go into CAT Scanner, and I looked at my combo leaders list, so I'm not looking at a lot of ETFs or cheap stocks or illiquid stocks. There's not a lot here that have dots and are in an uptrend with a recent pullback and reversal, which is the trade I take. SSYS had a bid come in this week. No surprise, it gapped up. Someone wants to buy it. Smith & Wesson brands holding up well. And I think there's a lot of drivers of this one. Whenever there's a whisper of gun control, people go out and buy guns. ERJ is, I think, a Brazilian plane manufacturer. Didn't close well, but had a nice move on the day. When I looked here and I looked at all these stocks, a couple of them I put on my buy watch list, which all it means is I'm going to watch them on Monday. GoodRx. This is one that's a cheap stock that's been beaten down. I love this because even though I have pharmacy benefits, sometimes I go to get a script, and my benefits are horrible from work. And I pull up the GoodRx app, and it's cheaper. Took out the 200 on good volume and a nasty day. 3 dots, so it's got volume, breakout, and momentum. Look at relative strength and OBV. Even the weekly looks like it's stirring. I thought that GoodRx looked interesting to the long side. Don't know much about IAA. It's in the auto auctions. I like buying things off of support. Now it just had a massive move and 10% move, so it's maybe too late. But here's a stock, and it had to be on news or earnings. You don't see this in a down market without that. You can see a big move up on massive volume. Now, I mentioned the contra ETFs, and this is probably as good a time as any to mention them. A lot of people don't like to short the market for various reasons. So let me just call out a couple. The dog goes up when the diamonds come down. All right. So we knew that the Dow was weak, and if you look at the week on the dog, it was up 4.63%. S&P 500, you can buy it. I think this is 2x, and then SPXS is 3x, and you could see the 2x one was up 9.7% on a weak market. These will go up when the S&P 500 goes down. TSA will go up when the Russell 2000 is down, and we know it was weak this week, down 8%, and the contra ETF was up 27.5%. The majority of it coming the last 2 days of the week on massive volume. And then we already talked about volatility. Another way of playing that could have been one of the volatility ETFs. This is the VIX VXX. UVXY is another one. And you can see a big move there, a 33.85% move. So there are things you can play if you're an account that can only go long. Let me just reiterate. Contra ETFs go up when the underlying index or group that they are matched to goes down. You can find contra ETFs on indexes. If you think real estate is going down, you could actually find a DRV, which will go up when real estate goes down. If you think biotech is going down, LAB, down, D, will go up when biotech goes down. So you could see if you think these markets are got more to go and you want to safely play them to the downside with no unlimited risk, meaning it's a long position, not a short position, these contra ETFs can come in helpful. Now, of course, if you think the market's going down a lot, you could be shorting individual stocks. Now, there's reason to do that instead of buying ETFs or buying puts because there's no premium. But if you short an individual stock, um, you potentially carry a unlimited risk. Now, notice a lot more stocks are here. There's never a fourth dot. So ARES, capital management, and you'll see a lot of the capital management stocks sold off, probably because either they had exposure to SIVB or they got taken down with the sector. Now, when I see a stock that has a big down day, I look for a reversal. I also see the 200 right below, so it's not one that I like to short. KKR is another similar stock, and you could see a similar pattern. Now, notice here, massive volume. Notice the relative strength, the OBV, 3-time frame bongos, the red dots. It's a perfect story. Now, what I'd like to see is, do I think it's just going to go down like that? No. But what I'd love to see is it to come up here and then turn down and then short it somewhere in this area. That's how I like to short. I'd rather short after a big move like this down. I'd like to short the retest failure. So there's going to be a lot of stocks, and I saw a lot of stocks when I looked through my review that look like that. Here's Caterpillar. Still a ways away, 15 points, 7% from its 200, but I'd be looking for a retracement before I'd short. John Deere, same story, broke down from the 50 and the 17. It's crazy how many of these shares. Brazil, which had been strong, breakdown. Health Equity, that massive break. Again, after a move like that, you almost got to expect a little bit of a recovery. Ingersoll Rand, big uptrend, broke down, big run here to the 50, another 10-12% move. Again, I'd be looking for it to retrace, fail at the 50, give me what we used to call an ice-hole failure. So there are things here that you can short. Everybody has their own way of trading, their own way of shorting. Axosome, I mentioned before, this is one that traded off after hours and late in the day because it had exposure to SIVB. Look at the volume. So you can also look at individual stocks to short. So let me summarize up my thoughts for the week. 1, this market is extremely oversold, as shown you by the buckets and some of the other breadth indicators I used. 2, we are in a bear market. Just because we're oversold does not mean we can't get more oversold. And that's one thing that I learned, because this chart here was crafted during bull markets. And when I got to the 2008 bear market, I found that we can get much worse. I think there's a story there. We can get much worse. All right. I think you got so much in front of us, CPI, PPI, Fed meeting in a week, and then we still got to sort out what's happening with this here, what's going to go on with the banks. And I think that it's hard for me to want to be long right now. It really is. And if I miss 2 or 3 days of a massive rally, I'm okay with that. I think that it's hard for me to go massively short right here because we've got too much news that's going to vacillate and drive the market. Although I did mention I liked some of the country ETFs here, which is a safe way. Taking long and doing options, all I can lose is my premium. The banks, it should cause us to worry. And I think whether it's different companies coming up with alarms about their at-risk positions in the beginning of the week, or other banks that are going to come up that have similar problems. That Bank of America, that would be too big to fail in my opinion. The potential contrarian view is the Fed's going to have to pause. Not saying they have to pause, but that could be a contrarian view. And if there was indication that the Fed was going to pause, that could be very healing for this chart. And not only why, because the markets will rally and those unrealized losses will become mitigated. So be careful. This is probably the most challenging market I've ever seen. Look, 2022 sucked if you were long. It was great if you were short. It was directional. It kept going the same way. It gave you very predictable patterns of bear market rallies that you could make money both ways. This one, the risk here is too much. And again, if Powell comes out before the market opens on Tuesday and says, hey, we are data dependent, but it's not just inflation. We're worried about the economy. We're going to pause. I don't think the market goes lower. So I think if I have to guess where we're going lower. We're going down those October lows to retest. It may turn out to be how we end this bear. But boy, this slide has me worried. Have an awesome week. Sorry I didn't depress you. At least I tell you what I think.